Inflation. It sucks. But it has become more prevalent with COVID, the supply chain crisis, lockdowns, and a Russian invasion, particularly with gas prices. But this has been contrasted with record profits made by energy companies linked to widespread outrage. In response to this record inflation, UK Chancellor of the Exchequer Rishi Sunak announced a £15 billion package that is partially funded by a £5 billion windfall tax. This package includes a £400 discount to millions of households to pay for energy bills, a one-off £150 disability cost of living payment, pensioners receiving £300, and 8 million low-income households receiving £650. But what is a windfall tax? A windfall tax is a one-off tax targeted on companies who made unexpected profits in circumstances that they were not responsible for, like, say, the invasion of Ukraine leading to Russian oil not being an option, or global demand rising after lockdowns start to ease. The tax will be 25% on top of any current tax that energy companies are paying and will only be applied for the next 12 months. It also cannot be reduced by previous losses or expenditures. The Tory government initially opposed the windfall tax for concerns on green energy investment and being less reliant on Russia, while the Chancellor said he was not naturally attracted to such a tax, but would be pragmatic about it. So I will leave it to you to decide if you flip-flop. Regardless, the question remains, is the windfall tax a good idea? Such a tax has been rarely implemented, so there isn't much to draw from, but there have been windfalls within the United Kingdom in 1981, 1997 and 2011, as well as one in America back in 1980. But the American windfall tax and the 1997 UK tax were both on energy companies and have been thoroughly investigated, so we will check those out. According to a study done on a 2005 American wind tax proposal, it would negatively affect domestic oil production and retirement savings along with limited tax benefits. One of the justifications of the windfall tax is the argument that it won't distort economic decisions, investments, or markets because the profits are unexpected and abnormally high. Hence, a tax on these large profits won't hurt the ability of companies to fund their upkeep and costs, or to generate normal levels of profit, and the unexpected profits shouldn't have been a factor in companies' investment plans. However, one of the main factors in giving oil companies extraordinarily high profits in 2005 and now is oil prices. Oil prices are not economically unanticipated, as they often have long-term increases and declines. So oil companies base their investment decisions on these price increases and decreases, even when they don't know the timings of such changes. In fact, these price changes may be accommodated by periods of economic booms and slumps for the oil company, forcing these companies to use their high profits gained during the boom years to finance their losses during the slump years. But with a windfall tax targeted on the quickly accumulated high oil profits, oil producers will have much less to help them during periods of loss, slowing domestic investment. This effect occurred with the 1980 US windfall tax. The study further analysed the 1980s policy, where it was expected to generate $279 billion, but it only provided $79 billion in gross tax revenues and $39 billion in net tax revenues. That's less than 30%.
What?
Why was there such a large disconnect? Well, half of revenues that could have been collected from oil companies were lost due to corporate income tax deductions, and as the windfall tax lowered American oil production by 3 to 6%, potential revenues were further cut, along with lower than expected oil prices. As oil firms are price takers, they couldn't pass the cost onto the consumer, so lowered production instead to compensate. With output being hit, corporate earnings, dividends, and stock prices will all obviously fall, with stock value not increasing as much by from 2.7% to 10.9%. In addition, the 2005 American windfall tax would have hurt pensions if passed, as all significant retirement savings include investments in the energy sector. American retirement funds and savings have 50% invested in equities, of which 4.3% is shares in American oil and gas companies. These funds hold $267 billion in oil company stocks, or 41% of the market. Hence, Americans who are contributors or collectors of pensions will bear 41% of the shareholders' costs. The average retiree or worker will lose $50 to $287 per year, or $4 to $24 per month, depending on the inflation rate from 3% to 6.5%, and oil prices from $45 to $60. the value of these retirement accounts seemed to be distributed between 60% public sector and 40% private sector. Again, I must reiterate that these hypothetical effects would have occurred if the 2005 windfall tax was passed. Moreover, there has been an argument that oil companies have received large subsidies over the years, which justifies the large tax, specifically £13.6 billion between 2016 and 2020. However, the people who came up with this figure included both a £9.9 billion tax cut and £3.7 billion towards decommissioning costs, and argued that the definition of subsidy includes tax cuts and is the same definition used by the World Trade Organization and International Monetary Fund, but contested by the UK government. This is interesting, as subsidies are generally considered as direct government money transfers to businesses, while tax cuts are simply just lowering tax rates. More basic econ websites agree with this idea, but more advanced sites consider tax cuts as subsidies. Still, even considering subsidies and tax cuts as two different things, £3.7 billion is still a hefty amount, and tax cuts can turn into a subsidy through tax allowances being so generous that they become a negative tax. This seems to contradict the argument that large sums aren't provided to oil companies when they make a loss. On the other hand, BP suffered a loss of £4.2 billion within the UK back in 2020, and I couldn't find domestic loss figures for Shell in 2020. But they appear to have lost £14.7 billion globally due to the pandemic. These figures are too large to be covered by the £3.7 billion, and the £3.7 billion subsidy applied to oil companies and not just BP and Shell, so the two companies wouldn't have got that whole amount over a period of 4 years. And we all know that other oil companies have suffered major losses during the pandemic. Accounting for these losses, and assuming tax cuts are not subsidies, the $5 billion tax on oil companies would vastly exceed their gains from government. A professor claimed that these recent profits were not expected, so will not deter investment. But as these energy companies have gone through large losses via COVID-19, they would not only expect large recoveries after COVID, but also large profits to compensate their COVID-19 losses. Maybe save up for future recessions like the pandemic, and fix problems like supply chains that led to the high gas prices in the first place. Such a tax for such a volatile industry in terms of booms and busts can drive energy companies away from the UK. There have been concerns that the windfall tax will hurt British pensions just like the American projection, but less than 0.02% of main pensions own BP and Shell shares, with just 8% of BP and Shell shares being owned by the UK pension funds, as well as not many pensioners are heavily invested in equities. There will be a few losses by pensioners, but even then, this is partially offsetted by the £300 given to pensioners, as mentioned before, which is funded by the windfall revenues. Now we know that one of the major reasons the American windfall tax generated very little than expected was due to corporate tax deductions, but the United Kingdom is a different regulatory environment to the US. Good thing we have another oil-based windfall tax enacted in the UK back in 1997 by the Labour government. Thanks Tony Blair.
I don't care, because I ain't bothered.
It was proposed due to perception that privatised energy companies were sold too cheaply and was projected to raise £5.2 billion. And guess what? It did raise £5.2 billion. So it appears we may not face the tax deduction problem that the American version had to deal with. It may have also been effective because it was a one-time tax based on past economic data. So those energy firms couldn't change their present-day actions to change past data to avoid tax, so lowered investment is less of a concern. But not so fast. Labour announced their policy back in 1993, which gave the market a significant amount of time to adjust share prices. This was important, as a good rule of thumb for a windfall tax is that its one-time aspect is credible to businesses. As in, companies shouldn't worry about future windfall taxes, maybe on an annual basis. If they do worry, then they may alter investment decisions to the detriment of the economy. It appears, as the case with the 1997 tax, it is best to say in advance the details of the windfall tax, which is not the case with the present-day windfall tax, where at best, companies had a couple of months' notice of a different version by a different party. Also, just because deductions weren't applied in 1997 doesn't mean the current UK windfall tax will have no deductions. In fact, there are loopholes included in the tax, the main one being the investment allowance, which encourages investment by allowing them to save 91p for every £1 they invest. The end result is double the tax relief for the energy companies. But what do oil companies say about whether windfall tax affects their investment? Well, it's kind of mixed. BP said no investments would be paused if the tax was passed, but Shell is publicly concerned that the uncertainty of the tax threatens North Sea oil investments and the developments in low-carbon energies. Overall, for a windfall tax to be truly effective, it must meet the following conditions. Its one-time feature must be considered credible by energy companies, though their investment decisions don't change. National pensions shouldn't be heavily invested in energy company shares to avoid hurting pensioners. And there should be limited or no tax deductions to avoid dramatic cuts in projected tax revenues. The windfall tax meets the pension criteria, but for the most part, we will have to wait to see if the windfall tax truly works for Britain. Of course, I'm against this tax due to my conservative bias, mainly because I think these energy companies are justified in using their high profits to finance themselves during inevitable future periods of dramatic losses in such a volatile industry. Nevertheless, even I have to admit that these companies have received overly generous subsidies from the government, which may have justified outcries for such a tax on those corporations. In spite of my biases, I hope you found this video and sources useful, or that I did try to best represent both sides of the argument. If you have any objections to anything I've said, please feel free to comment below, and I may release a response to commentator James O'Brien on the windfall tax next week. Anyways, I hope you enjoyed this video. If you did, please give a like and comment, as it really helps my video in the YouTube algorithm. And if you like economics and political commentary, consider subscribing. Maybe follow me on my Twitter, and see you later.